Alright guys, welcome back to Chart Nexus. My name is Darren and today I'm going to be sharing with you one of the most popular indicators used by traders all around the world, and that is the MACD. Alright, so today I'm going to show you how to use the MACD and what exactly is the MACD. Alright, so let's get into it. So first off, what is the MACD? A MACD is basically a trend following momentum indicator. Alright, and basically how it does that is that it shows you the relationship between two EMA lines. Now remember, EMAs are indicators that calculates the average price of a stock at that given moment. Alright, so let's get into it. What is in a MACD? Alright, so there are three components that are present in the MACD. The first component is basically the MACD line. Now the MACD line is calculated by taking the EMA 12 and minusing the EMA 26. And the value you get forms the MACD line. Alright, the next component is the signal line. Now the signal line is basically the EMA of the MACD line. Now remember what I said about EMAs? EMAs are basically a way to calculate what is the average at that given moment using its historical prices. And in this case, the signal line uses a 9-period EMA line to calculate its signal. Alright, and the last component we have in a MACD is the histogram. The histogram basically tells you the difference between the MACD line and the signal line. Alright, so if you don't understand what I'm talking about, let's look at an example. Alright, so here we have Emulus, alright, and then we have a MACD at the bottom of the chart. And if you don't know where to put up the MACD, we can just go to the side in the indicator panel, scroll down, look for MACD. Alright, so basically if you do this, the MACD pops up. And as you can see, the default values are what I just explained. 26, 12, and the signal line using a 9-period EMA. Alright, so in this indicator, the blue line is the MACD line. And the red line is the signal line. And here we have a zero axis, which basically tells you the difference between the 12 and the 26 EMA is positive or negative. So if you don't understand what I mean, so let me show you how the MACD line is calculated. So let me just pull up two EMAs. And okay, so both of them, I basically pulled up the 12 EMA and the 26 EMA. The blue line being the 12, the red line being the 26 EMA. And we can see that when the 12 EMA is above the 26 EMA, the MACD line is above the zero axis as well and shows positive value because the difference between these two lines is positive because the 12 EMA is higher than the 26 EMA. And we can see that when the 12 EMA crosses below the 26 EMA, the MACD line, let me adjust the axis so you can see better. The MACD line in this area is below the zero axis, meaning it's negative. Alright, so that's basically how the MACD line is calculated. Basically the difference between the 12 EMA and the 26 EMA. Alright, now the red line, like I said, is the signal line, which is basically the 9-period EMA of the MACD. That's why you can see that the red line is usually smoother because it's the average across 9 periods of the blue line here. And that's why the MACD line is usually more choppy because it's more price reactive. So it's more sensitive to price changes and trend changes. And last, we can see in the middle, we have the histogram. And remember what I said about the histogram? The histogram is basically the difference between the MACD line, which is the blue line here, and the signal line, which is the red line. So if the histogram shows up above the 0 axis, which is basically like the center line here, means that the MACD line is above the signal line. And if the histogram is below, it means that the MACD line is below the signal line. Now, whether it's green or red, to make it simple, when you see that the bars are green, it means that the MACD line is angling upwards. And if you see that the bars are turning red, it means that the MACD line is starting to angle downwards. So as you can see here, the MACD line from this point turns green because the MACD line angles upwards. It turns upwards. But once it reaches this point, you can see that the histogram starts to turn red. It means that it's starting to angle downwards. As you can see, it's starting to angle downwards and crosses below the signal line. The same thing when it's below. The histogram is red and it's increasing, meaning that the MACD line is angling downwards and pulling away from the signal line, meaning the distance between them is growing. And once it starts to turn green, meaning like here, means that the MACD line is starting to angle upwards. And it is, in this case, you see, it's starting to turn, and although it's not, and it's starting to angle towards the signal line. So that's basically what the MACD is. Alright, so let's go back. So what does the MACD tell you? Alright, what signals does it tell you? Now generally, the MACD line, whenever the MACD line crosses above the signal line, it gives you a buy signal. And the same can be said for the opposite, which is when the MACD line crosses below the signal line, it gives you a sell signal. Now do keep in mind that this is an indicator, which means that it is supposed to act as a confirmation for other analysis that you have done to the charts. It should not be taken as it is, which means that it's not always the case where if the MACD line crosses above the signal line, you take a buy, and every time the MACD line crosses below the signal line, you take a sell. Because I can show you many situations such that if you were to follow the MACD signals exactly as it is, you will be taking a lot of false trades, meaning false signals, right? And another thing I want to touch back is that the MACD indicator, as I've touched just now, is basically a trend following momentum indicator, which means that it is best used when there is a clear trend in place, whether it's an uptrend or a downtrend. So it means that when a market is on a sideway or consolidating, the MACD will produce a lot of false signals. Let me show you an example of what I mean by that. Now here we are back at Emulus again, and I just want to highlight a particular part of the stock movement, which is this area. Now we can see that the stock was trending and it came to a sideways consolidation period here. And how do I know it's sideways? Basically, we know that we can see that it's trading in between these two ranges. Hence, it is a clear sideways market. So let's zoom in. As you can see, if you're in this period right now, you can see that the MACD has a lot of crossovers. Just can't see clearly. Let me just try to expand it for you guys. You can see that the MACD has a lot of mini crosses. Like here, it crossed above the signal line for a little bit, then crossed below, cross above, cross below, cross above, almost cross below, went above, cross down, basically continuously doing that. And if you're currently in this market right now and trading off the MACD indicator, you will be taking a lot of false trades, meaning false signals. So that's why it's very important that MACD is used when a trend has already been established. It doesn't have to be a very long trend. It can be it can be at the start of an early trend, but a trend has to be in place for the MACD to work better for you. All right. So that's just something that I want to remind you guys of, because it's an indicator. You should always use it as more of a confirmation tool rather than a signal generating tool to tell you when to buy and when to sell. All right, remember, it's used for confirmation. All right, okay, let's move on. So another reason why the MACD is so popular among traders used around the globe is because that the MACD is used by traders to identify potential reversals that's about to happen in the market. So how do these reversals get identified? Is by looking for divergence. Now, divergence basically means that the MACD is not doing the same thing as what the price movement is doing. So what do I mean by that? If you see a stock where the price is making higher highs, meaning it's on an uptrend, but you notice that the MACD is making lower highs, it is a sign of a divergence, meaning a potential reversal to the downside is likely to happen soon. The same can be said for when the price is making lower lows on a downtrend and you notice that the MACD is making higher lows. It's telling you that the market is highly likely to reverse to the upside soon. All right. Now, if you're very confused on what I've just said, let's look at some examples. Okay. So here, let's go to DNO. All right. Let's zoom out. As we can see here, prior to this uptrend, the trend on DNO was down. So you can see the stock was making lower high, lower lows, lower high, lower lows. And it's interesting to see is that when you see the price making this low compared to this low, the price was making a lower low. But what's happening with the MACD is that the MACD is making a higher low. See? Let me repeat it again, right? The price is making lower lows. As we can see, this low compared to this low is making lower lows. But the MACD is making higher lows, which signals that the market is likely to reverse soon. And the market did reverse after that, before encountering the coronavirus crash that happens to every market. That happened with every market. Okay, so basically this is an example of a bullish reversal happening, where the price is making lower lows, but the MACD is making higher lows. Now the same example can be seen here for when the price is making higher highs, the MACD is making lower highs, which tells you that the market is likely to reverse soon, and the market did, as we can see from this drop here. Okay, now another example we can also see is if we can go here, you see that the market, let me just adjust the chart. You can see that the market made a high here and a higher high here, but the MACD was making a lower high. As you can see, the stock did a big pullback or a short reversal, making a low, lower high, lower lows before going up again. But notice that here it's making another high, but the MACD is making a significant lower high. So this tells us that it's very likely that this stock in the upcoming days will reverse and pull back downwards. All right. Now another example we can take a look at is Emulus again. And I want to show you the example here. You can see that the price was on a downtrend, making lower lows, lower highs, lower low, lower highs. Now pay attention to this particular point here, when the stock was making this low and another lower low, but the MACD was making a higher low, which tells you what? That the market is likely to reverse to the upside soon. And the market did. As you can see, the market did reverse into an uptrend. Right? So that's basically what it means by divergence, meaning that the price is doing something, but the MACD is doing the opposite. Alright? Now remember, in the downtrend, we look at its lows. In the uptrend, we look at its highs. Right? So that basically concludes MACD and what it's used for. So by now, I hope you have an understanding of what exactly is a MACD, what is in a MACD, and what the MACD does for you. Now do remember that MACD is an indicator, and most importantly, it is a lagging indicator. So it should always be used as a confirmation tool with other analysis tool as well. Alright, so I hope this video has been able to give you an understanding of what the MACD is. So if you like the video, please give the video a thumbs up and subscribe to the channel for more. Alright, so that concludes the video for today. My name is Darren from Chart Nexus, and I'll see you soon.